Welcome back to Rocky Mountain Residential, a podcast hosted by MCM Collective. I'm Kelly McBartlett. Today we're talking about financial planning, and we've brought in an expert, Jesse Jorgensen with Foresight Financial Group. He's a partner. Welcome, Jesse.
Thanks, Kelly.
Yeah, glad to have you here. So we're in a wine cellar in this listing at 400 Wedby. The materials used in here are modeled after a English pub, believe it or not. Really cool. I wish we were drinking wine.
I was going to say wine cellar fashioned out of an English pub, but we're missing a key ingredient between us.
Yeah, exactly. Well, next time. We'll
Afterwards.
have to remember that.
Yes.
Yeah. So tell us a little bit about your business.
Yeah, partner and director of financial planning for Foresight Financial Group, and we work primarily with individuals, families, business owners on creating comprehensive financial plans and solutions for their lives. And often when we begin working with our clients initially, they're at different ages. Many of our clients are in their 50s, but we have folks in their 60s, 70s, 80s, even clients in their 30s and 40s. But primarily when we work together, they've got stuff already in place. They have some investments, they have usually some real estate, could be a business or other assets. But what we've also noticed is they have a growing number of questions that they're not getting answers to.
Okay.
Things like, do we have enough of the right stuff?
Yeah.
Is it the right stuff? And how's all this going to work someday when we need this plan to go live?
Okay. So I know that people in your industry are all not cut from the same cloth. There's different qualifications, different certifications. Tell us a little bit about the differences that exist there.
Yeah, I appreciate you asking. Lifelong learning, I think in any industry is really important, and ours especially. And there's a number of credentials that professionals in our business can get, as is yours. I would say, the one that probably stands out the most is the Certified Financial Planner designation. Last I checked, there's about 30% or so of professionals in our business with that designation. And it's really considered the gold standard of educational and ethical excellence. As a certified financial planner or CFP, we're required to act under the fiduciary standard, and regardless of what scope we're working in with clients, we're required to do what is in absolutely their best interest, which I'd like to think that most folks in our business would just do as being a decent human being. And I think a lot do, but having the CFP mark requires that we do so.
Okay, great. That's great to know that designation. So in our business, real estate is obviously our focus. How does that fit into financial planning?
Well, we love real estate in financial plans, and I say so because real estate is such a unique asset. You have the valuation, the appraisal value, by and large, I'd say, is rather separate from the income that clients can generate. Now, there's some influence, certainly, but I compare that to assets where we're creating income for our clients, and as our clients draw down on their investment accounts, their values are drawing down. That doesn't necessarily happen in real estate, right? That the home's going to appreciate whether you're renting it or not and drawing the income. And so we love that element in real estate and in testing our financial plans. Our strongest financial plans that we notice for our most financially secure clients have a strong level of base income, and oftentimes that is through real estate. Now, of course, real estate has its own challenges as well. So I think understanding the pros and cons and kind of fitting that puzzle piece into an overall plan is where our clients find the most value.
So along with that, we have seen statistics that most people, the largest portion of most people's wealth is held in real estate equity. How does that help or hinder them when it comes to retirement planning?
I think as long as folks are clear on what the goal is, then I wouldn't say maybe it helps nor hinders. For example, we have a belief that a successful, especially retirement income plan, has three components. Base income that you can never outlive. We think of that as mailbox money. That's where real estate fits in.
Okay.
We want a strong level of base income in retirement for our clients. Second component is a cash reserve to tap into during down markets, down stock markets. And then third component are having investments that are going to fight inflation, but also offer some tax and distribution flexibility. So in that lens, if our client is balanced between those assets, we find that works really well. In your example, if our clients maybe are heavier real estate than the other assets, we wouldn't say that's a bad thing. What it means typically is they have more guaranteed income, maybe a little bit like less immediately accessible cash if they need to tap into it, but they could always pull the lever and sell a property or two and free up cash. So again, I think through the lens of the plan, as long as our clients know what are the strengths of having maybe more of their equity tied up in real estate and what might be one or two of the drawbacks, if they're comfortable with that, then we found those plans work really well.
Yeah. Okay. Great. And we do have clients too sometimes that focus almost all of their retirement planning around real estate. Would you say that precludes them from investing in additional assets, or how does that fit into an overall plan?
Maybe, yeah. There's only so many resources to go around. I think no matter what life stage we're in, if clients are in their 20s, 30s, 40s, raising kids, maybe they're in their 50s, 60s, getting near or approaching or maybe even into retirement, having a strong representation in real estate, again, I think is fine, as long as clients know maybe what they could be missing. So for example, if maybe we have a large part tied up in real estate, that probably does mean we have less dollars to invest in things that maybe we help them with directly, individual stocks, bonds, alternative investments. Again, those provide the liquidity, but of course real estate's going to provide the income, which is frankly nothing that we can provide as advisors, in my opinion, is going to quite match the income, but also the appreciation that real estate offers.
Okay. So, sometimes we're working with younger clients and they're, thinking about what their financial picture looks like in the future. A lot of times they've not met with a financial planner and they feel like, gosh, that seems like a really big step. That's something I'm going to do later in life. Do you feel like people should wait? Should they talk to somebody in their 20s when they're just, starting into gaining income? And how do you take that?
Yeah, I think there's a few reasons why I've noticed folks will wait. But to answer your question, but maybe before I get to that point, it goes back to what I said at the beginning. If individuals have a number of questions that they're starting to ask, they're just not getting answered, whether it's from their own research, whether it's from their existing investment advisor, that's probably a time to meet with a financial planner and just have the initial conversation. Our team makes this commitment. I know other CFPs in the business do as well. The initial meeting, there's no fee for the initial consultation, just to see if we're a good fit and we get a sense of what questions are on the minds of those individuals. We can also explain how we work, how we're compensated as well. And for some reason, if we just find out from that meeting we're not a good fit, whether it's the cost or otherwise, that's okay. Nobody's out anything. And at least then that individual's had a chance to ask some of their questions. So I would say that though, that if they're starting to realize, man, I have this retirement plan through work, and maybe I'm doing some other investing. Are there things I'm missing? And I have goals. I want to accomplish our goals. I think that's a good time to at least reach out and have a conversation with someone like us.
And that's even if they have some sort of plan set up with their employer, still reach out and talk to you.
Absolutely.
Okay.
I would say, without exaggerating it, just about every client we work with has some plan through their employer, and we'll simply fold that plan into what we're already doing within their comprehensive financial plan.
Okay, interesting. My guess would be a lot of people don't realize that. So I'm glad you brought that up. Another thing that comes up, especially when we're working with younger home buyers, is they might not have the source of cash for a down payment that they would like to have, or they might not have any source of down payment. And we've begun seeing a lot more, the generation before them, their parents or grandparents helping them with down payments, either from their their existing retirement plans or other assets. How does that look? I mean, how does that impact the parents' plans? How does that impact the financial picture for the kids? What are your thoughts on that?
That's a really interesting question, Kelly, and we can answer that from two different perspectives. And one is if maybe we're advising the parents who would be making that gift. Yeah. Primarily, we want to ensure that our clients themselves are financially secure prior to gifting significant dollars to their kids, grandkids, whomever their ultimate beneficiaries are. But once we've been able to confirm that they are financially secure, we probably want to start getting some dollars out of their estate earlier. There are some gifting strategies we can utilize for that older generation. Transitioning that to the younger generation, and I firmly believe this as a CFP, I don't know if there's any greater financial benefit than home ownership and having a piece of the American dream. And so the clients that we find who are able to buy a home, and in particular in the cases where they've maybe been gifted the down payment to go purchase the home, I mean, that kind of launches a different trajectory for them in their life. They've got the home, they're not paying rent anymore, they're building equity, and it almost like changes their thinking as far as their level of maturity and decision making and setting goals for themselves and their family.
Yeah, it's really, I mean, when I've seen that happen from my perspective as a real estate professional, either with their own funds or gifted funds, it seems like those clients really do, like you said, just go. They're in a different trajectory.
Totally.
And they're making different decisions. That all of the risks and fears that they may have had about owning a home kind of evaporate. And a few years down the road, they're their financial picture has totally changed, and that was the singular decision.
Absolutely.
Yeah.
Well, if you have a couple, right, or they're thinking about having kids, starting a family, what a blessing to get to raise your family in a home that you own, or eventually will,
Yeah.
when it's paid off.
Yeah, absolutely. So another aspect of financial planning that I hear a lot from clients and people in my life is tax avoidance or kind of tax planning as it relates to financial planning. What's your advice around that? Some people seem to be very preoccupied with it. Do you feel like that's a good position to come from, what are your thoughts?
Kelly, are you saying you prefer not to pay taxes? Is that
I'm not saying that. I think everybody should pay their fair share, but I don't want to pay too much, of course.
totally?
So yeah,
I'm obviously giving you a hard time. I think most of us would agree. We prefer not to pay more taxes than we need, but also we're willing to pay our fair share as well. And tax mitigation, that's the term we prefer to use.
perfect. Okay,
Yes.
not tax avoidance.
Correct.
Okay,
Yes.
got
Yeah,
it.
tax mitigation.
We don't want to
compliance. We're saying mitigation.
IRS disregard what I just
Exactly.
said.
Yes.
Okay.
Tax mitigation. Very important. And regardless of, even if you take this to like a Washington level, who's in office, I think taxes are going to increase. It's no secret that our national debt is rising, and there's a few different ways typically out of debt. Most common lever to pull is the raise the tax lever, and that could be state taxes, like we were talking earlier, of gifting dollars to the next generation. Could be capital gains taxes, certainly applies to most real estate transactions. Could be ordinary income taxes as well too. And so tax mitigation, like especially as our clients' net worth and affluence grows, that's a larger and larger part of the work that we do with folks, and something I think humbly we're pretty good at in planning.
Great. Okay, that's great. So people are living longer and longer, and maybe folks have a trajectory of how long they thought they were going to live and plan their retirement plans around that, and they're living longer than they thought they would. How are you advising people in terms of planning for increased life expectancy?
Well, life expectancy, I think, is maybe just one way in which we can attempt to be as conservative as possible in our assumptions within a plan. For example, on longevity, it's on average, men and women right now, we live late 70s, early 80s, somewhere in there. But it seems like that's going to continue to increase as advances in technology continue. What I'm curious about is whether health span will continue with that, or maybe what the end of our last decade or two of our life will look like from a health perspective. But yet to find out.
Well, I'm glad you brought that up about just health costs later in life, because they're becoming more and more increasing. Medical costs are extraordinary in this country. How are you helping people prepare for even that component of retirement?
Absolutely. Different inflation rates. And so for healthcare costs, for example, we're going to assume that the costs of those are going to increase at likely a more rapid level than day-to-day utilities, groceries, some of those costs that they're paying for.
And I would suspect that as people age, that cost is probably projected to be higher the more years that you live. So you have to kind of plan for that in a different way.
Yeah, we tend to see spending in retirement almost like a smile, where spending early on in retirement tends to be higher because our clients are doing fun stuff and cool stuff while they're young and able to enjoy life. And then as reality of our health starts to set in, spending starts to decrease because we're not traveling as much, maybe not as involved in the community as we once were, with accompanied maybe an end of life spike in spending, as some of those healthcare costs near the end of our life do require more capital.
Okay. Yeah. Interesting. Super interesting. So there has to be innovative products that are happening in your industry. What are you watching right now in terms of innovations in financial planning and the financial world in general?
Yeah, well, one of which, and there's a number of firms that are providing this right now, but I've been surprised to find this is still kind of the minority in our business, is like truly objective financial planning. So the traditional model in our business might be a financial advisor wants to manage investment assets and do a great job at it and charge a flat fee to manage dollars. That's still a very valuable solution we found for our clients. What more folks are asking for, though, is, can you just give us objective advice as fiduciaries? Can you design a plan for us? Maybe we're happy with this people seated at our planning table. Maybe we have our CPA or our attorney. Maybe we have our investment advisor. real estate advisor, lender. So we have the folks at our table, but we just don't have anybody tying the work of all those folks together. And so firms like ours, we will design and implement a comprehensive financial plan for our clients, answer all the questions that are coming up that they can then take back to their other advisors and say, okay, real estate advisor, we're thinking about doing this, or here's something that our financial planner brought up. Could we maybe look at some options of how we can infuse that real estate portion into our plan? Same with the wealth management advisor too. So I think comprehensive and truly objective planning is still kind of somewhat rare in our business. There's also some cool online tools as well. So for folks that would prefer not to meet with a stuffy financial advisor like myself in person.
You're not stuffy.
Well,
Jesse.
thank you. Thank you.
I've met some other people, but not you.
Well, there's a stereotype about us in our industry for a reason, right?
Yeah.
But no, all jokes aside, there's some great online tools, some great platforms that folks can kind of test some of this stuff if they're a little more tech savvy online to do on their own.
So interesting, you talked about, being this true fiduciary, building a plan for people. Is that like at a flat fee basis, or how does that work, Jesse, in case people are interested in that?
Yeah, we charge a flat fee for it,
Okay.
and the amount of the fee completely depends on the scope and the complexity of the plan. The engagement itself tends to be about 4 or 5 months, maybe 6 months on the high end.
Okay.
And by the end of that, our clients have a fully personalized and detailed, thorough financial plan, as well as personalized recommendations that they might implement. They might ask for our help. They might take back to their other advisors and implement as well.
Okay, interesting. That's a really interesting thing I've not heard of somebody talk about that before, so very, very good. So sometimes, we kind of talked about this early in the conversation, but sometimes our clients are fearful of making that initial call to a financial planner. Why do you think that is? Why do people have that fear of talking to you?
I think it's a few things. It could be the perception of what's this going to cost. Below that, though, I think there's even a deeper concern of just fear in general and facing our finances head on. Whether I'm an individual, couples, maybe even more often. Oftentimes, we see couples that have both partners in the relationship having a very different opinion on dollars. Maybe just generally speaking, one tends to be a saver, a little more conservative. One tends to be a spender, and hashing this stuff out can create anxiety in couples. And so I think human nature, right? We prefer to avoid conflict as humans. And so oftentimes I think the thought is, let me just keep my head in the sand like an ostrich. And again, not picking on folks, we're all guilty of it. But I think that maybe that underlying fear of, is this going to hurt either emotionally or with my wallet, financially, to go through this experience. And what we find is the exact opposite. Our clients come out of the experience often closer than they were, but also knowing that all their most important objectives are going to be accomplished.
Yeah. I think that was a really good way that you summarized that, and it's my personal experience too. When we met with you initially a few years ago, my fears were exactly that, what you described, and I felt like it was so demystifying. We just felt like we were on a path after that and knew what we were doing. So I would recommend to everybody to meet with you, you or somebody like you sooner than later. So obviously financial planning is a huge topic. There are so many different ways that you can approach this. What is your advice in general for people if they were to take away one thing from this episode? What would you leave them with?
Start by setting goals. And that's whether someone's going to meet with somebody like us or even just beginning the process. That the initial step is, what do I want to accomplish? Where do I want to be in a year? Where do I want to be in 3 years, 5 years, 10 years? We might know some of the shorter term stuff, but we probably don't know the answers to some of those longer term questions. And I think beginning that discovery exercise is really important. Another foundational step that for many folks feels like a 4-letter word is establishing a budget.
Okay.
Even if very simple, to get a sense of where's our spending going. Again, I think back to that fear component. I found that's oftentimes a source of fear too. Is, do we have to confront our spending? And the answer is yes. To accomplish goals, we at least want to know what we're spending. It doesn't mean we have to change any habits. Maybe we do, but at least know where the dollar's going. Those two, I think, first steps: setting goals, get a sense of our spending, and then things get a little more complex after that.
Great. And if people are struggling with budgeting, Is that something you can help them with?
Absolutely. We can help. Again, some great resources online, a few of which you need a budget. YNAB is a company we've seen a lot of clients have success with, regardless of what the format is, just getting a sense of where our dollars going and where do we want to begin devoting some dollars. If we can cut down some of these expenses, but devote it to something that really is meaningful for us, whether that's retirement or sending our kids to college, helping our kids buy a home at some point.
Great. That's great. Well, this has been really great, Jesse. We should do it again in the cellar or maybe not somewhere else.
Absolutely.
We'd love to have you back. So thank you all for tuning in. See you next time.